global monetary system beyond gold. Once upon a time, money didn't derive its value from faith. It drew its strength from precious metals. Gold was the universal anchor, representing stability and unquestionable trust. Nations pledged that each banknote issued would be backed by an equivalent amount of gold in their vaults. This system didn't just preserve real value, it enforced fiscal discipline. No government could recklessly print money, and that limitation created a stable and transparent financial order. In those early days of modern finance, gold was the silent enforcer, ensuring every currency behaved responsibly. But as the world marched through wars, crises, and globalization, the gold standard became a bottleneck. Economies expanded rapidly, demanding far more liquidity than the world's gold reserves could support. Thus began the era of fiat money, a system where currency is backed not by metal, but by belief. Now, money's value hinges on the government's authority and public trust. It was a bold move, one that untethered currency from tangible assets and tied it instead to perception, reputation, and national governance. The shift from physical value to perceived value was a turning point in economic history. Fiat money was a true revolution. Without gold, its worth now depends entirely on the faith of citizens in their government. A strong currency, therefore, is no longer about metal, but about political credibility, inflation control, and stable financial systems. This means a nation's greatest asset isn't oil, technology, or land. It's trust. A currency survives and thrives based on how much people believe in its future. Trust has become the invisible gold of the modern era, a resource that's earned, not mined. Imagine holding a piece of paper that holds no gold inside, yet everyone around you agrees it's valuable. That shared belief gives money its strength. Since abandoning the gold standard, the world entered a realm where currency no longer reflects physical worth, but collective confidence. Money today is a mirror of trust. Whoever can cultivate and protect that trust wins the financial game. In the world of fiat, perception isn't just important, it's everything. Supply and demand, the heartbeat of currency. Picture money as a product on a supermarket shelf. Like any product, its value depends on supply and demand. If many people want a currency because they trust the economy behind it, demand rises, and so does its value. On the other hand, if people avoid a currency due to fears of instability, its value sinks. Currency is alive. It breathes, fluctuates, and responds to global appetite. Just like viral products in the marketplace, some currencies trend, while others gather dust. The strength of money doesn't come from ink or paper, it comes from global desire. A growing economy, transparent regulations, and credible institutions make a currency hot property. Investors, companies, and even governments want to hold it. As demand soars, the currency appreciates naturally. Think of it like a brand. People want the Apple of currencies: reliable, safe, prestigious. The more attractive your economy, the more your currency becomes a status symbol in global finance. But let's be honest, people don't hold money out of patriotism, they do it for utility. A strong currency stores value, enables smooth transactions, and reduces risk. That's why weak currencies get dumped. Economies plagued by corruption, hyperinflation, or erratic policy can't maintain demand. And when demand fades, so does value. A currency no one wants is not just worthless, it's a burden. It crushes local purchasing power and erodes financial hope. In the grand arena of global finance, currencies fight for attention. The ones that win trust dominate trade, investment, and savings. Look at the US dollar, the euro, the yen. They didn't get there by chance. The market crowned them because of what they represent. Value isn't assigned, it's earned. A currency must be desired, used, and relied upon. Demand is everything. Without it, a currency is just paper with history. With it, it's a financial passport to global influence. Inflation. The silent destroyer of currency. Inflation is an invisible assassin. It doesn't shout, doesn't crash markets overnight, but it silently erodes the value of your money day by day. When a country prints more money than its economy can support, the currency loses purchasing power. People need more cash to buy the same items. This isn't just price increase, it's the slow death of trust. Nobody wants to hold a currency that vanishes in value. Inflation doesn't just crush savings, it suffocates the very confidence that gives money its power. Currencies once revered can become jokes in a matter of years if inflation spins out of control. Zimbabwe is a cautionary tale. Once relatively stable, its government began printing money recklessly. Combined with poor leadership and policy failure, inflation exploded. A loaf of bread cost billions of Zimbabwean dollars. At that point, money stops functioning as money. It becomes symbolic paper, used not to buy, but to remind people of economic collapse. Trust evaporates, and chaos takes its place. Inflation isn't just an economic issue, it's a human crisis. It hurts the poor, obliterates the savings of retirees, and paralyzes businesses with unpredictability. When prices shift faster than paychecks, society unravels. Plans become meaningless. Forecasts are useless. In hyperinflationary times, money is no longer a tool, it's a ticking time bomb. The social contract between citizen and state begins to crack. Currency fails to represent value, and the economy loses its compass. Fighting inflation isn't glamorous, it's gritty work. It requires strict monetary policy, clear communication, and political courage. You can't print trust, you must earn it. Responsible governments understand. Controlling inflation is defending the power of their people's money. Without that, no reform, no growth, no promise matters. Currency can't defend itself. It needs leadership that values discipline over convenience. When that leadership fails, inflation isn't just a financial threat, it's the beginning of economic exile. Interest rates. The magnet for global capital. Interest rates aren't just numbers read on financial news, they're signals to the world. When a country raises its interest rates, it's sending a clear message. Invest here and earn more. Investors love return. And if a nation offers better returns on bonds, savings, or deposits, global money will flow there. This surge in demand boosts the currency's value. Interest rates are more than policy. They're magnets. Powerful, precise, and capable of shifting billions across borders in seconds. But higher rates come at a cost. As borrowing becomes expensive, consumers slow spending, and businesses hesitate to expand. Real estate cools, growth slows. That's the dark side of attractive returns. Central banks walk a tightrope, raise rates too high and choke the economy, keep them too low and risk inflation. Each rate change is a strategic chess move. Behind every decimal lies a gamble with growth, unemployment, and national competitiveness. Interest rates are the pulse of a nation's financial health. Rise too fast, shock the system. Fall too far, invite inflation. But with the right balance, they become a conductor's baton, orchestrating investment, savings, and spending in harmony. Nations that manage interest rates wisely don't just attract capital, they earn global respect. In a world guided by ROI, interest rates point the way. Investors follow yields like moths to a flame. Look closely and you'll see. Strong currencies aren't accidental. They're crafted by intelligent, adaptive monetary policies. A well-calibrated interest rate keeps the economy breathing, the investors interested, and the currency resilient. It's not about being high or low, it's about being right. The art of rate setting is the art of controlling your destiny. It's the invisible lever that lifts or collapses the value of a nation's money. Economic and political stability. The stage where currencies shine. A currency is not just numbers, it's a reflection of trust in the nation that issues it. A strong currency stems from political stability, transparent legal systems, and dependable governance. Global investors don't throw money into chaos. They seek consistency, long-term policies, and clarity. They want to know the rules won't change after every election. Where there's institutional integrity, currency finds strength. Where there's predictable leadership, money feels safe. A nation's economic story writes itself into its currency. Every policy flip-flop, every prolonged protest, every sudden tax reversal cracks the wall of confidence. And when confidence leaks, currency value drops like a stone. No one wants to hold a currency tied to dysfunction. Worse, no one wants to invest long-term in a place where rules shift by the hour. Currency cannot withstand volatility. It demands firm footing. It flourishes in systems that operate with transparency, accountability, and foresight. Trust builds resilience. Look at emerging nations that open their markets with structure. Like China in the late 70s. When the doors opened and laws adapted to foreign investment, capital flooded in. The currency gained power because the world wanted to do business there. The truth is, the world isn't short on money. It's short on places to trust. When your nation becomes that place, your currency becomes a beacon. It's no longer just money, it's a symbol of global reliability. So, if you want a strong currency, build a trustworthy nation. Money doesn't thrive in disorder. It needs solid institutions, clear policies, and governments that honor their word. When trust is earned, through every policy, every speech, every decision, the currency reflects it. It steps onto the global stage not as a note, but as a statement. This country is worth believing in. Confidence isn't printed, it's built. And when it's built well, money speaks with power. Global trade, the gateway to currency demand. Trade isn't just about moving goods, it's about moving money. When a country exports, international buyers must purchase its currency to pay for the goods. More exports mean more people demanding that nation's currency, driving its value up. Every product sold abroad, from cars to electronics, isn't just a business success, it's a win for the national currency. Trade becomes a pipeline, channeling foreign money in and boosting the home currency's global standing. Nations that dominate exports don't just earn profits, they earn influence in the monetary system. But it cuts both ways. Countries that import more than they export need to buy foreign currencies to pay their bills, resulting in more of their own currency being sold. That excess supply pressures the currency to weaken. Nothing reveals a currency's strength quite like its trade balance. The countries that sell more than they buy control the currency game. The ones dependent on imports, they're always playing catch-up, reacting to others. In global finance, self-sufficiency isn't just patriotic, it's profitable. Look at how the US shaped the global financial system with the petrodollar strategy. By persuading oil-producing nations to sell crude exclusively in US dollars, America made its currency indispensable. Nearly every nation needs oil and therefore needs dollars. This wasn't just trade, it was geopolitical engineering. The dollar became the ticket to energy, and by extension, a must-have for every government and corporation worldwide. That demand helped the US dollar ascend to dominance not just in finance, but in influence. But not every country has oil or global export power. Small nations with limited goods for export often find their currencies irrelevant in international markets. When demand is non-existent, your currency becomes invisible. These countries are forced to use dominant currencies like the US dollar or euro to engage in trade. So if a nation wants its currency to thrive, it must first craft a smart, sustainable export strategy. The world buys products, and by doing so, it also buys the currency behind them. Fixed exchange rates, stability at a cost. In a world of ever-fluctuating currencies, some nations choose a different path, pegging their currency to a stronger one. This strategy, known as a fixed exchange rate, means the local currency maintains a set value against a major global currency. No surprises, no wild swings. It sounds simple, but it's a deeply strategic move. Countries peg their currencies for one reason: stability. But that stability comes with strings attached. When you peg your currency, you're not just borrowing value, you're borrowing someone else's heartbeat. If they tremble, so do you. Take Brunei as a prime example. Instead of reinventing the wheel, they pegged their currency to the Singapore dollar at a 1-to-1 ratio. The result? Predictable exchange rates, consumer confidence, and investor security. In fact, both currencies are accepted interchangeably. But beneath that ease lies dependence. If Singapore's economy were to stumble, Brunei would feel the shockwaves. Their monetary fates are tied. You rise when they rise, but when they fall, you're going with them. Pegging is peace, but it's peace on borrowed ground. Belize follows a similar model, pegging its currency to the US dollar at a fixed 2-1 rate. This simplifies trade, tourism, and investment. No guessing games with exchange rates. But like every convenience, there's a price. Belize can't independently adjust interest rates or devalue its currency to help exports. It must follow the Federal Reserve's lead, even if the local economy requires a different approach. It's like dancing to someone else's music, even when your own rhythm says otherwise. Fixed exchange rates are a double-edged sword. They offer stability, but sacrifice flexibility. Nations that peg must hold large reserves of the foreign currency they mirror and adopt strict financial discipline. They cannot easily stimulate growth or respond to local crises without risking the peg. If the anchor currency falters, the pegged one sinks too. It's a trade-off, security versus sovereignty. For small economies, it can be worth it. But they must remember, stability is not the same as strength, and in pegging, you borrow peace at the cost of independence. Why not use one global currency? The idea of a world dollar sounds amazing. No exchange rates, no conversion fees, seamless travel, and global business. But beneath this attractive simplicity lies a dangerous trap: losing control over national monetary policy. Every country has a different economy, different needs, and different challenges. A single currency would mean one central bank for the whole planet. But who gets to make those decisions? And what happens when one country's crisis spreads through the entire system like wildfire? The cost of unity might be the loss of financial self-determination. Europe tried this dream with the euro. Initially, it was hailed as a triumph: economic cohesion, easier trade, and stronger bargaining power. But when crisis hit, like in Greece, countries were trapped. Greece couldn't print money, adjust interest rates, or devalue its currency to recover. It had to wait on the European Central Bank, which served 19 different nations with conflicting priorities. What started as unity became burden sharing. One weak link pulled down the whole chain. The Eurozone revealed the ugly truth: shared currency means shared vulnerability. Now imagine living in a stable country, yet suffering inflation because another nation thousands of miles away mishandled its economy. That's the reality of a single currency without unified governance. A global currency might simplify commerce, but it magnifies risk. Without a world government, without shared fiscal policy, taxation, and accountability, this idea remains a fantasy. Attractive, yes, but impractical. Monetary freedom gives nations the tools to solve their unique problems. Take that away, and even the strongest economies become hostages to decisions made elsewhere. Is a strong currency always the goal? Most people assume that the stronger a currency, the better off a country is. And yes, a strong currency means cheaper imports, affordable travel, and greater purchasing power. But if you're a country that depends on exports, a powerful currency becomes your enemy. Why? Because your goods become more expensive abroad. Demand drops, competitiveness fades, factories slow down. A currency that's too strong can suffocate the very industries that fuel growth. So the real question isn't how strong can we be, it's what strength actually serves our strategy. Take China, for example. For years, it's been accused of deliberately weakening its currency to make exports cheaper and drive manufacturing growth. And it worked. With cheaper goods, China flooded the world's markets, built jobs, and climbed the economic ladder. So is a weaker currency a weakness or a tactic? The answer is clear. Devaluation can be a weapon. It's not always about prestige, it's about purpose. Sometimes weaker means smarter. Currency, after all, is a tool. And tools serve strategies, not egos. So what's the lesson? A strong currency isn't always the prize. The real goal is alignment. A wise nation uses its currency like a compass, sometimes pointing north for stability, other times veering south for competitive exports. Strength means nothing if it pulls you away from progress. Weakness isn't failure if it fuels growth. A currency should never be an ornament, it should be a lever. Controlled, measured, strategic. In the end, power isn't about how loud your currency roars. It's about how well it serves your people.